Our 2021 Bowtie Nation portfolio is up over 30% and beating the market by 20%, but not all the stocks have been big winners, and a few are even down double digits.
I am so sorry.
In this video, I'll reveal those biggest winners as well as the stocks that haven't done so well. I'll show you how to review your own portfolio, how to decide whether to hold a stock, double down, or cut it fast. We're talking portfolio investing today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel, and before we get started, I've got to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, investors get so excited about finding the next hot investments that they end up with a portfolio of 50 plus stocks. They have no idea what's in their portfolio or why it's not growing. In fact, the truth is, and Peter Lynch said this best, usually the best stocks to buy are those you already own. But the only way you know which stocks to buy, which to hold, and which to run screaming from like a teen at Crystal Lake is to check your portfolio regularly. So today, I'm going to show you how to do just that with our very own 2021 Bowtie Nation portfolio. The portfolio is up 32% so far this year and beating the index by over 20%. But it's time to review those winners and the losers. You see here, we positioned early in those energy and financial stocks to ride that shift in investor sentiment, but it seems like some of these may be tapped out. We were also early to some of those reopening stocks in the consumer discretionary sector that haven't quite panned out yet. So we need to review the portfolio, see what's worked, and how to invest going forward. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the stock pick sections there. It's free to follow and you'll get email notifications whenever I buy or sell from the portfolio. As a special bonus, I've negotiated an exclusive discount for all you out there in the community. Use the promo code Bowtie Nation, all one word in lowercase, for an exclusive discount beyond the free trial. Now, if we look into the portfolio, we've got some real flyers here like Diamondback Energy up 177% and MCore Group up 77%. 18 of the 24 stocks are up and beating the return on the S&P 500. But there are also the ideas that haven't worked out yet. Teladoc is down more than 20%, and 4 of the stocks are underperforming the market by double digits. And this is why you need to review your portfolio at least every 3 months, see what's worked and just what hasn't. It's going to give you some clues into your investment strategy that you're never going to get by reading more analysis or just watching a guy rock a bow tie on YouTube. And for most investors, doing this every 3 months is more than enough. In fact, you might even be able to do this just once or twice a year if you have a lot of funds and that laid-back approach to investing. So now I want to show you 3 steps to reviewing your portfolio, and then we'll apply it all to our Bowtie Nation stocks as an example. And first here, is there a link between the best and worst performing stocks? So you got to look at your portfolio and then ask yourself, are all the best stocks or the worst in a specific stock sector or a theme like growth or value stocks? If they are, do you see that trend continuing then? All you out there in the nation know this big picture investing idea, this is my favorite strategy because it is so much easier to spot those broader, those bigger trends. And once you have a feel for that direction, then you're just picking from a few stocks in those trends that are going to benefit from those trends and then riding the wave higher. Second here, you ask yourself, how much do you have in each sector or theme within your portfolio? Now this is going to mean finding the sector or the theme in which each stock belongs. Is it in healthcare or technology or that energy stock sector? Is it a value stock or a growth stock or some other long-term theme? And then you're going to add up each sector or each theme to see where you're most exposed in your portfolio. So here you see the 11 stock sectors and the main industries in each. Now stocks in each sector serve a common need like financial services or technology, while the industries are smaller groups of companies that sell a similar product or a service. And for all the naysayers of diversification out there, I know there are a lot of tech investors out there that made a ton of money last year by having every penny in those high-flying tech stocks. But if you want to make your money over the long term, over decades instead of just 1 year, you have got to diversify. Now, I would aim for no more than maybe 20 or 25% of my portfolio in any one sector. So no more than a quarter of your stocks in tech or healthcare or any single sector. And then third here, what is the fair value estimate of each stock you own? Are there any that have surged way above what you think is reasonable, or are there any screaming buys out there? Now, this doesn't mean you have to sell a stock immediately when it goes higher than your target price. In fact, maybe there's new information out there and your target price should be higher. Now, using these 3 steps in our 2021 Bowtie Nation portfolio, first, it's easy to see where the returns have come from. We've got an average return of 54% in our 5 energy stocks and 49% in those 3 banking stocks, Citigroup, Wells Fargo, and Citizens Financial. The healthcare stocks we added early, like CVS and Anthem, have also done really well, while the ones we added this month, Teladoc, Fresenius, and Tiva, are all lower. Now, like we talked about in our last portfolio update, stocks in the energy and financial sectors are looking a little topped out here. And most are kind of flat over the last year, and I don't think there's quite as much opportunity here in these 2 sectors versus maybe stocks in the healthcare, materials, or industrial sectors. And we've also got some underperforming stocks like Madison Square Gardens and Cinemark in our consumer discretionary sector, and I still like these on that reopening trade. Now, looking at the portfolio, I was actually really surprised at what I saw at this sector level, and this is absolutely why you need to do this step in your portfolio review. Using our stock tracker spreadsheet, I can see how much I have in each sector, and this is even going to show you the comparison to the percentage of that sector in the S&P 500 index. So now we've got our biggest investments in healthcare, along with energy, financials, and communication services. These are sectors that I probably don't need to add because they're already overweight in the portfolio. What's really interesting though that I didn't realize was we have nothing in the materials sector, one of my favorite stock sectors for this year, and very little in industrials, which is another sector that I think can do really well. We're also underweight in technology and real estate, and while I think technology is still a little expensive at this point, there are some solid real estate stocks that could help diversify the portfolio. This can be a great way to just step back and look at that bigger picture of your investments because most of the time, stocks are going to trend along with the broader sector or the industry in which they operate. Now that can mean hard times for your portfolio if the sector sells off, so spreading your stocks out a little bit can help protect your sanity in any kind of a crash. Now on those price targets, Diamondback Energy is above my $75 per share price target and has struggled to stay above $83 each, so it might be time to take some of the profits there because the upside is probably going to be a little bit more limited. Citigroup is also one that I would look to take profits around that $75 a share. I think we've seen a lot of the gains that we're going to see for most of this year, though that long-term investors can still collect that dividend and hold the shares. But for our portfolio, if I'm looking to reduce that exposure to financials a little to make room for something else, maybe something in the materials or the industrial sector, I'd like Wells Fargo here better than Citigroup because I think Wells Fargo has more upside for the rest of the year. And Wells Fargo is just coming out from under some of the capital controls set by the Federal Reserve after its problems over the last few years, and there's a good chance that we get a higher dividend on that stock later in the year. Also here, since we have so much in healthcare, it might be a good idea to revisit some of the valuations to see if there's something we can take profits in, again, to make room for something else in the portfolio. And here, Anthem is right around my $400 price target, and the risks are probably more to the downside, especially on any kind of regulation out of Washington. So here we could cut Anthem if we want to make room for some of the stocks in those other sectors like materials, industrials, or even real estate. So then if we take profits on a few of these, free up some money, besides adding some of those stocks in the materials and industrials, I think I would like to add more in Madison Square Garden Entertainment and Cinemark Holdings. I still like both of these on that reopening trade and think we were just early into the shares, so maybe adding more for that upside into summer. Click on the video to the right for the 3 top stocks for the electric vehicle revolution, 3 EV stocks to ride that trend. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.